Now, the stock market isn't just one giant auction house, it's more like a network of exchanges, kind of like different branches of a bank, where these stocks are bought and sold. Think of places like the New York Stock Exchange or the NASDAQ. Big names, big players. These exchanges are the arenas where the action happens, where the buyers and sellers duke it out. But here's the kicker. The stock market isn't just about gambling on individual companies, it's the lifeblood of the economy. Think about it. Companies get the money they need to grow, create jobs, and innovate. You, the investor, have the potential to grow your wealth. And the economy? It gets a much-needed boost. It's a win-win. Let's talk trading. Remember those exchanges, the NYSE and NASDAQ? They're like the stock market's grand central stations. Each exchange has its own personality, its own listing requirements. The NYSE, that's the old guard, the blue chips, the big guns. NASDAQ? More tech-heavy, think Silicon Valley darlings. But hold on, how do you actually buy or sell a stock? You don't just walk into the NYSE with cash in hand, though that would be something. You need a broker, your trusty sidekick in the world of investing. Brokers are like the middlemen, connecting you to the exchange. They execute your trades, buy and sell orders, all that jazz. Now in the good old days, brokers were these guys in fancy suits yelling on a trading floor. Today, it's all about the internet, baby. Online brokers, trading apps, they've made investing accessible to everyone. Just open an account, fund it, and bam, you're ready to roll. But before you go on a stock buying spree, let's talk about the two main types of markets, primary and secondary. The primary market is like the IPO launchpad. A company decides to go public, they offer their stock for the first time ever, and investors line up to buy in. The secondary market? That's where the real action is, the trading floor we see in the movies. Investors buying and selling from each other, stock prices fluctuating like a roller coaster. Buy low, sell high, that's the name of the game. So, how do they determine the price of a stock? It's not like there's a giant price tag hanging off Apple headquarters. Stock prices are all about supply and demand. The more people want a stock, the higher the demand, the higher the price goes. Simple, right? But wait, there's more. A whole bunch of factors influence demand, and therefore the price. Company performance is huge. Are they making money, growing their customer base, innovating like crazy? Good news tends to drive stock prices up. Bad news? Well, you get the picture. Then you've got the economy. Is the economy booming? People feel confident, they spend more, companies do well, stocks go up, recession on the horizon, people tighten their belts, companies feel the pinch, and stock prices might take a tumble. Don't forget about interest rates. The Federal Reserve, they're like the conductors of the economic orchestra. They raise interest rates, borrowing gets more expensive, companies slow down, stocks might dip, they lower rates, well, it's party time, sometimes. And let's not forget about sentiment, the emotions of the market. Fear, greed, they can swing stock prices like a pendulum. Remember, investing isn't just about numbers, it's about psychology too. Alright, you're ready to dive into the stock market, but where do you start? First things first. What's your strategy? Are you in it for the long haul, buying and holding for years, riding out the ups and downs? Or are you a short-term trader, looking for quick profits, buying and selling on a dime? Long-term investing, that's like planting a tree. You pick a solid company, believe in its potential, and let it grow over time. It's less about timing the market, and more about time in the market. Short-term trading, that's more like surfing. You're trying to ride the waves, buy low, sell high, but it's riskier, requires more attention, more skill. And speaking of risks, let's not forget, the stock market is not a guaranteed path to riches. It's an ocean of opportunity. But there are sharks in the water. You could lose money, especially in the short term. Market crashes, economic downturns, unforeseen events, they can all impact your investments. That's why diversification is key. Don't put all your eggs in one basket. Spread your investments across different companies, different industries, even different asset classes like bonds or real estate. Remember, the stock market is a marathon, not a sprint. It's about patience, discipline, and making informed decisions. But here's the bottom line. The stock market, for all its risks, offers incredible potential. It's a chance to grow your wealth, participate in the economy, and maybe even own a tiny piece of your favorite companies. Just remember, knowledge is power. Do your research, understand the risks, and invest wisely.